Good morning. Today, I want to talk to you about a very technical aspect of our business, and that is position sizing and portfolio management. A lot of people ask us, what is your largest position? And I'm happy to discuss what our largest position is, but people ask this question with the underlying assumption that our largest position must be the position that we have the greatest conviction in, or the one that we expect to really outperform the most in the near future. And nothing could be further from the truth. That's why I want to take this time today to explain our portfolio position sizing and how we manage that micro level of position sizing and portfolio management. So our investment strategy combines a qualitative and discretionary technique of selecting companies based on moats, growth opportunities, and management. And we're looking for 20 to 25 positions at any given time. As of this time, as of the taping of this video, we have 24 positions. And we take our 24 positions and we combine that with a long-term treasury position. And we use long-term treasuries because we believe they're a great diversifier, especially in times of market stress. They help reduce the volatility of the portfolio. So we have our 24 positions plus our bond position, and then the actual dollar allocation to each individual position and the portfolio trading of those positions is determined through a quantitative process that is rule-based and is completely non-discretionary. So we take our positions and we throw them into an optimization process, which is proprietary to us and uses tools I have designed over many years. Our process takes into account the volatility of every position and its correlation to the rest of the portfolio and the market overall. In other words, we're going to overweight in our portfolio positions which have lower than average volatility and positions which trade more independently from the market, or in technical parlance have higher idiosyncratic risk. So stocks that are trading more on their own story and less on their beta loading to the overall market. Because we're trying to capture the performance of underlying businesses rather than the performance of the market itself. So as of the taping of this video, early February 2009, our largest position is AutoZone. It's our largest position not because we think there's going to be a massive surge in demand for auto parts in the near future. That's somehow not captured in the stock price. AutoZone is the largest position that we have because the stock trades much more on its own story over the last year and a half or 2 years rather than the market overall. And you have to remember what has happened to AutoZone and the other auto parts retailers over the last few years. There's been a big threat into the perception that investors have had about AutoZone and O'Reilly and several others after Amazon announced they're going to expand their auto parts business. These have been great businesses, but people thought once Amazon is going to get in, these will become mediocre businesses at best. And so the stocks fell very sharply because of this threat. And ever since, they have been actually outperforming quite well because the threat of Amazon's entry hasn't resulted in any meaningful impact on AutoZone's P&L. So that's why AutoZone has traded a little differently than the rest of the market, and that is captured through the quantitative measures that we look at and is ultimately resulting in the largest dollar allocation that AutoZone has in our portfolio. So we're combining the qualitative approach of selecting stocks based on their competitive advantages and a quantitative way to manage the portfolio and allocate the dollars. The second thing I want to talk about is that once we establish the dollar targets for each position in the portfolio, we just mechanically trade the portfolio to meet those exposure targets that we have. We're trying to manage our risk exposures rather than managing short-term returns, which we believe are completely unpredictable. So the only thing that we can really do, that any investment manager can do in the short run, is manage the amount of risk they are taking. So that's what we're trying to do. So we are managing to specific targets of risk exposure. And that means if some stocks decline sharply in value, we're going to end up buying them to meet our exposure targets. And if some stocks in our portfolio sharply outperform, we're going to end up trimming that position to, again, keep it within the bounds of risk exposure that we need. So we're not making any discretionary decisions to buy a little more, sell a little here, simply because stocks have moved up and down. And I believe to do that discretionarily would introduce enormous amounts of bias, as people have overconfidence bias, loss aversion bias, fear of missing out, etc., etc. And I believe this approach of looking at the qualitative factors, selecting businesses with competitive advantage based on qualitative factors, and combining that with a quantitative, systematic, rule-based way of managing risk and constructing a portfolio is ultimately the best way to manage our fund. And with that, I'd love to hear your questions, and I'm always happy to talk about our largest positions.